We do, let's talk about Sagility and what a set of numbers this company has posted. You have margins that have been under pressure, but it's a positive guidance, and more than anything else, I think the management commentary is what is being sought very closely. So let's bring you that. We've got Ramesh Gopalan, the Group Chief Executive Officer and Managing Director of the company, as well as Doraiswamy Srinivasan, and they're going to be speaking to Puneet. Puneet, take it away.
Let me first start off with, the one key highlight from your results that's very difficult to ignore, and that's the increase in guidance for margins specifically in this particular quarter for FY26. What are you currently seeing on the ground that's leading you to such positive outlook in terms of FY26 at a time where the healthcare-focused industry in the US is seeming to be slightly under pressure? So what's driving this positive momentum?
Thanks, Puneet. Yes, we had a very strong set of numbers in Q1, and that's the momentum that's giving us confidence that FY26 will be a good year for us. A couple of things on the macro, like you said, there's a lot of things happening in the US healthcare, but a lot of them are tailwinds for us as clients come under more cost pressures and margin pressures. They're looking at partners like us to support them in their transformation journeys. And so since we operate in core operations, which is a non-discretionary spend for our clients, it is that area where clients are looking to improve efficiencies and take costs out. And that's where we partner with our clients to help them in their journey. So that's likely to continue, and that's likely to get a lot more impetus with the profitability pressures, and that's why we are confident.
Just to follow up, sir, because you mentioned that a lot of cost takeout deals has been happening in this industry, and it's quite similar to the commentary we're getting from other IT players as well, that the transformative deals are currently on hold, seeing a lot of cost takeout deals, but for them, the margins are quite lower in that. How does that compare for you specifically in terms of raising the EBITDA guidance in this year, despite going to a cost takeout deal model, at least for now?
Look, our business model, again, going back, we run the core operations for our clients, right? So when clients come to us, they obviously want us to run those operations at a lower cost. And they give us the latitude to transform their operations. So we use technology, we use automation, analytics, AI. We deploy them in the operations that we run for our clients. So unlike an IT services company, which actually does the project, we actually deploy those technologies in the operations work that we do for our clients to help them take out cost. And in the process, the client gains, and we also stand to gain in terms of keeping a bit of those efficiencies for ourselves.
And so, we also saw a couple of acquisitions, especially BroadPath in the last year as well. You had mentioned that this could be some kind of margin dilutive, but given this context of increasing the guidance, how does that shape up for this year?
That's still true. The EBITDA margins of BroadPath is lower than Sagility margins. And while we are working on synergy benefits, which will improve their EBITDA margins over a period of time, the dilutive nature of the BroadPath business is still true. If you realize our EBITDA numbers last year were even higher, right? So we had already guided to some dilution in the EBITDA margins because of BroadPath acquisition. But the guidance that we gave last time to what we are saying now is the EBITDA margins could be a tad better than what we had guided in the past.
And it could be in the range of 120 to 150 basis point as was indicated?
Yes, more likely in the 120 basis point range. Yeah.
And so in terms of deal wins as well, that's also been again a very strong one in this particular quarter. Is there any kind of differentiation that you're seeing from because you had 18 deal wins from existing ones, but also 4 new deal wins from new customers? Is the trajectory similar to, as you mentioned, on cost takeouts as well as efficiency in their existing systems for US right now?
Yes, a lot of focus is on efficiency and cost takeout. But going back to your question, the 18 deal wins from existing clients, that's been the nature of our business. Most of our growth comes from existing clients. And once we build a relationship with a client, we tend to expand that relationship. And so that's played out well for us in the past, and that continues to play out well. But the specific nature of deals that you're talking about, yes, it's outsourcing by the very nature is for clients to get a lower cost. But in the current scenario, that pressure on further reducing the cost is just amplified.
Point, sir. And it's very interesting because while building into your existing clients as well as deepening your experience with them, the new client additions will of course help you in the medium term as well for increasing the aspects. So point well taken. Just one question, and that's been the talk of the town, which has been artificial intelligence, and how is that helping your current business? With your business momentum of reducing cost and as well as improving processes for your clients, has that already been incorporated in your existing deals, or are you being able to charge a slight more premium for the services offered with AI as well as integration of that in your current systems?
Yeah, so it's a little counterintuitive, right? So to your first question, the adoption of AI is gradual, right? So I won't say it's been deployed across the board. Like we've highlighted in the earnings call, we have deployed a number of use cases in our existing clients, and we continue to increase that penetration. To your specific question on how this works out, I'll take you back to the cost takeout, right? If I'm doing a certain piece of work for a client at let's say $X, the client wants me to deploy technology and bring down that X to X minus 10% or 20%, right? And so the question is not getting an incremental revenue because of transformation. It's actually reducing the cost of operations for the client. The way that we are able to retain our margins and grow our margins is we can possibly increase more efficiencies than the efficiencies that we give clients through price reductions. And so part of the effort that we get back basis the efficiencies that we generate also helps us retain our margin. So overall, while the revenue might be cannibalized when you do transformation because you're taking cost out, which means your revenue reduces, it could help you stabilize and improve your margins.
All right, so that's the management of Sagility talking about the road ahead looking much brighter than anticipated, and so that's reflected in the stock price as well.